So good afternoon, everyone. Thank you for joining us for the next hour. We've had over 200 people sign up to this session today, which is really excellent, and I think really shows how important this topic is and how much everyone is thinking about financial inclusion, financial exclusion, and the impacts of the cost of living crisis. So my name is Lauren Peel. I'm Head of Consumer Insights and Propositions at Fair4All Finance, and I lead the work around our segmentation. And today we're here to talk about what's changing and what's staying the same in financial inclusion across the UK. We all know that for people in financially vulnerable circumstances, things are getting worse. The evidence is all around us, everywhere, all of the time. In fact, this presentation could easily have been over 100 slides long, but you'll be pleased to know that we managed to cut it down, although we'll be sharing a longer presentation after the session for people who want to get into the detail. And today, using new insights for our 6 segments and from external sources as well, we're looking at what's changed across the last year and what's still changing. There are things in here that we expected and things that we didn't expect. And this is the first edition of what we hope will be a regular release of insights. And it's also a chance to continue or even to start a conversation about financial inclusion with the people in this virtual room and within your organisations. There's still a lot of slides in here. We'll try our best to keep to time and to take questions. Feel free to put your questions into the Q&A chat throughout, but we may not come to them until the end for timeliness. We also might not have the answers to all those questions, and that's okay too. If we don't, we'll take them away to think about and come back to you on. And some other housekeeping, this session will be recorded, and all of the slides and more will be shared after this session. So don't worry about taking notes on everything we discussed today. You'll have all of the information. I'm really glad today to be joined by Tom Johnson, who's Managing Director at Trajectory Partnership, who we've been working with on our segmentation research for more than a year now, and really knows our segments really well. So many of you will have seen this slide before, and it's also okay if you're new to the party and seeing this for the first time. These are our 6 segments of people in financially vulnerable circumstances that we released in September last year. And while all of these groups are in vulnerable circumstances, the x-axis shows the severity of financial difficulty, with 2 segments, credit crisis families and forgotten families, on the right-hand side, representing 7.1 million people. And the y-axis reflects age bands. You'll see we have both a younger segment, unsteady starters, and an older segment, on golden years, within our group of 6. I'm not going to say more on the details of each segment today. The vast majority of people will have received some updated pen portraits and personas from me in advance of the session over the last few days. And if you haven't yet, you can download all of that information from our website. I think we're going to put a link in the chat and the Q&A for you if it's not there already. That's too far. Here we are. And when we were planning what to discuss today, out of the hundreds of charts we could have presented, we kept coming back to these 6 themes that at Fair4All Finance we talk about around financial inclusion. It's problem debt, resilience, poverty premium, insufficient income, access, and financial capability. These 6 themes are the foundation of our financial inclusion action plan, which is being released in the next couple of months. And today we'll talk about how some of these themes show up in our research, and we'll be talking about other themes in the future. And very briefly, there's a number of data points in the kind of slides we're about to talk through, so I just wanted to cover off some definitions of the data sets. When we talk about our segments, this is how we talk about people in financially vulnerable circumstances. That's insights from all of our segments combined, which is at least 17.5 million people across the UK. We've also looked at a tracker across our segments from March to December 2022 to see what changed and what stayed the same over that time period. And we've looked at people in financially vulnerable circumstances compared to the nationally representative population, both data sets from December last year. And where it's relevant, we've included external data sources because there are some really great organisations building the case for change in financial inclusion. And as we said in the chat, you can find out more about our segments at our website. And now I'm going to pass to Tom to talk about key changes since our data was collected at the end of 2022 and where we are now.
Thanks very much, Lauren. Yeah, pleasure to be presenting alongside you on this webinar. It's been a busy period economically. We obviously were collecting our most recent data in December, and the cost of living crisis has continued since then. I guess there's mixed narratives on exactly where we are with the cost of living crisis. Are we through the worst of it? How long might this go on? Are there further policy initiatives or interventions that might come in to help tackle the cost of living crisis? What we do know is that financial pressures continue. So inflation, although we got news yesterday that things have dropped a bit, it remains really high, and interest rates continue to rise as well. And credit card interest rates are part of that, the highest on record. Some better news, although qualified positives here. Unemployment and employment has remained reasonably stable, and the winter itself wasn't quite as bad as it could have been. There were a couple of really cold snaps, which I'm sure we remember, but it wasn't quite as cold as it could have been, which is obviously, alongside some support on energy bills, a good thing given where inflation was around heating and energy. Also, and this really is, I think, damning the economy with faint praise, but we did manage to avoid recession just about over the past 6 months, and prospects for economic growth at a national level are looking as good as they have done for a little while. Despite that, we have seen no shortage of disruption, so continued strikes and industrial action affecting all manner of different sectors across the economy, affecting obviously people getting to work, affecting in the health service, planned operations and treatments and things like that too. Lots of spending constraints on part of the government, and obviously more externally, lots of downside risk, as the economists might put it. So ongoing trade instability and the war in Ukraine continues to have an impact on suppressing growth globally. So not a huge amount of good news there. I think close to home as well, we can continue to see contractions in the supply of non-standard credit as we see quite a few commercial providers exit the market. So I know Scott Cash and Tapley are among those. So quite a few bumps in the road over the past 6 months since we collected our data, but the headline being the cost of living still very much present as a concern for our segments. Back to you, Lauren.
Great, thanks so much, Tom. So, speaking of our themes, let's jump in with financial resilience. And of course, when we think of financial resilience, we think about savings. Across all of our segments, 1 in 3 people have no savings, so 33%. That compares to 23% in our nationally representative group, although interestingly, that's also up from 17% in 2022 from Money and Pension Service data. For our 2 most vulnerable groups, credit crisis families and forgotten families, it's over 40%. And for credit crisis families, we're getting up to 50%. And I'll also call out difficult debts. These are our highest income segments, some with incomes of over 50,000, and still more than 1 in 3 have no savings, which really speaks to the impact of those higher levels of debt. And when we were doing this data, we wanted to look at what's changed over the last year. For all segments except 1, the proportion with no savings has risen, with significant rises for unsteady starters and credit crisis families between the start and the end of 2022. That means we're talking about 6 million people in our segments with no savings. And given this was the end of 2022, I'd guess that this has increased further since then. I'd also call out Joseph Rowntree Foundation's tracker, which found that while 29% of low-income households have no savings, similar to what we found, this rises drastically for those on universal credit, for renters and for young people. And for the same reason that we've looked at segments, when we're thinking about designing products and services, this shows it's really important to look at the needs of different groups when we're designing solutions. And this will be no surprise to anyone who works directly with these customer groups. They all want to save. Everyone we speak to knows the importance of saving and wants to do it. It's kind of the making it happen that's hard. Even in challenging times, more than 2 in 5 people in our segments are still saving at least monthly. This is kind of one of the data points that we saw the least change in across 2022. But it's tough. The Resolution Foundation found that 27% of people can't afford savings of £10 a month, up from just 6% in 2019 and 2020, which is a massive increase. Tom, what else can we talk about in financial resilience?
So thanks, Lauren. Insurance is another thing that we can talk about here. And perhaps unsurprisingly here, we find that our segments are less likely to have insurance, various forms of insurance compared to the nationally representative populations. What we're doing here is comparing on the left of each of these, the nationally representative population, and then our financially vulnerable population on the right. And consistently, we see the financially vulnerable population less likely to have various forms of insurance. So around 15% less likely to have car insurance, around 15% less likely to have home or contents insurance, and less likely to have life insurance too. So around 1 in 3 people nationally have life insurance, but that's less than a quarter of people in our segments. And actually what we're seeing as well, if we move on to the next slide, is the presence of the cost of living as a factor in all of this. Half of the people in these segments are making some kind of change to their insurance arrangements and attributing that to the cost of living. So around 1 in 10 people are cancelling policies, around 1 in 10 people have reduced their level of cover recently, and around 3 in 10 people say that the cost of living is actively making affording their insurance harder. So actually we might well be seeing that number increase as those pressures continue. I think moving on to the next slide as well, it's really interesting to see this reflected in some other data. So this is data collected by the FCA, part of the Financial Lives data released earlier this year, who saw really significant numbers of policyholders cancelling. So around 3.6 million people, they think cancelling at least one of their policies, and 3.1 million reducing their level of cover, specifically to save money due to the cost of living. It's interesting to see the nature of those policies that were cancelled as well. So extended warranty, home contents insurance, pet insurance, gadget insurance, and mobile phone insurance, all the most commonly cancelled policies. And actually, some of this really tallies with what we've seen in the qualitative research, particularly around pet insurance. So many people in these segments, and over the course of this work, we've been visiting people in their homes to get a good understanding of what their circumstances are. And so many people in these segments have pets. And the prospect of an unexpected vet bill is a major anxiety and a potential risk for people in these segments in the future. So pet insurance being cancelled or being reduced is something that might not augur well for the future at all. Back to you, Lauren.
So what does this mean? It makes sense that with costs going up and salaries not rising as fast, people are using their savings to pay for ongoing costs. And at the same time, they're looking to make cost savings elsewhere, whether it's saving less, seeking financial help from friends or family, cancelling pensions and insurance payments. This all impacts their wider financial resilience and increases the need for credit as savings fail. All segments, especially unsteady starters and squeeze and sliding, want to maintain that savings behaviour and save for their own future and for their families. What propositions or activities can help us do this? For example, in our recent research on deductions lending, we found that 7 out of 10 borrowers agreed that when payroll-linked lending is packaged up with a savings element, it helped them to save more regularly. And for our more vulnerable segments, only 16% of benefit loanees had a savings account before a loan, and 73% had saved more since taking out the loan where there was a repay and save option. And in insurance, we've convened a financial inclusion action group with stakeholders from across the sector, including insurers, brokers, price comparison sites, all who share our mission to increase financial resilience through improving the availability of fair and accessible insurance products, specifically home, motor and income protection. And if you'd like to know more about that, you can contact my colleague Jake, who can bring you up to speed on that. Now, moving on to another theme, insufficient income. As Tom already mentioned, the FCA Financial Lives data, there was a new release last week, which I think really shows the really scale of the cost of living challenge in a nationally representative view. So given this was a national survey, we found that 72%, almost 3 in 4 people, say that keeping up with domestic bills and credit commitments is a burden. 1 in 10 had fallen behind on commitments or missed payments. And we all know that mortgages and rents have gone up. It's not a massive leap to say that for our segments, these numbers will be significantly higher. Tom is going to tell us about how this is kind of starting to show up for our segments, particularly in overdrafts.
Yes, thanks, Lauren. So initially looking at changes amongst the financially vulnerable population last year, so looking at the data we collected in March versus the data that we collected in December, and how people in these segments are using their overdraft. Initially, it's clear. So there's no huge drastic changes here, but actually a closer look at the data, as we'll do on this slide and the next slide, reveals a couple of really interesting trends. So first of all, I think there's a really interesting shift. The proportion of people who say they use it sometimes to manage incomings and outgoings, that's dropped a bit from 20% to 15% between March and December last year. And it looks like that's gone into the proportion of people who say they rarely get out of their overdraft. So more people, I guess, spending more time in their overdraft, even accounting for a very slight reduction in the proportion of people who say they never get out of their overdraft. So minor changes on this slide. But if we move on to the next slide, one of the things that we see is actually segment by segment, some much more impactful differences. So if we look here at the steady starters, that's an increase there from around 25% to 34% of people in that group of people who are either rarely or never getting out of their overdraft. The squeezed and sliding group, similarly, an increase from 20% to 27%. And forgotten families, another group where we see a substantial increase. And for the other segments, particularly credit crisis families and difficult debts, we see high levels of people being in their overdrafts pretty much all the time, either rarely or never getting out of it, that continuing. And obviously, I think one of the points to make here is around product appropriateness. If people aren't really ever getting out of their overdraft, it's unlikely to be the ideal product for them. Over to you, Lauren.
Thanks, Tom. We also looked at people who'd taken a loan or looked into taking a loan and the reasons why, and what this might mean in relation to an insufficient income. On the left-hand side, we see a big increase in people looking for a loan to pay off an existing debt. Now, joint as the most common reason for loan for our segments. Previously, it was falling behind the unexpected expense category. And then towards the right, we start to see a slight increase in people looking for loans to cover essential bills, especially those housing costs. So that's certainly a trend to watch for how people are using credit to meet those essential costs. I think another one, the eagle-eyed view will spot there's a few categories that have dropped off. So one-off large planned expenses for holiday cars, weddings, etc. Seen a big decline as people kind of move away from those higher expense costs. So what does this mean when we're talking about insufficient income? We know that as the gap between income and expenses closes, and in some cases starts to exceed it, it's going to be overdrafts, using savings and credit usage that will increase to balance those household budgets. Deficit budgets will unfortunately become the norm for many in our segments, and we know that debt advisors and other support services are already starting to see a rise in this. We know that more community finance providers and other organisations are adding benefits calculators and grant checkers into their journeys to help people, often finding up to £400 a month in unclaimed benefit entitlement, which are massive amounts for low-income households. 2 CDFIs have helped more than 88,000 lower-income households to identify 428 million in benefits that are due annually. We are working with organisations to get more of these benefit calculators and grant checkers into journeys to help people improve their incomes. You can contact my colleague Samson for more information on that. And finally, our reports we put out a few months ago, looking at the banking response to COVID-19 and how that could help people now, found that reintroducing an offer of a £500 interest-free overdraft to customers could benefit many who are in vulnerable circumstances. And I would say if you work in a bank or building society and haven't had a look at that report yet, I'd highly recommend it. It's got some real tangible actions on supporting customers in vulnerable circumstances during the cost of living crisis. Now, demand for credit. This is a challenging one. When we looked at the research data, it was a good reminder of sometimes the difference between what people say and what we see and hear in the market from providers. For example, a lot of people told us by the end of 2022, they had less of a need to apply for credit. This contradicted what we were hearing in the market and what we'd seen in the data, and is one for us to watch over a longer period of time. So with that slight contradiction in mind, let's have a look at what people told us. We know that demand in the credit market is up. This data is from the Bank of England, showing that demand is not quite to pre-pandemic levels, but it is on the way there. And this chart shows all unsecured lending, excluding student loans. And when we asked our segments what sources of credit they had or they used in the last 6 months, there had been an increase in all sources. And there's some things to note here. Credit card on the left-hand side is way up, and we also saw more people moving away from repaying in full each month, so having to use that kind of credit functionality. This is at the same time that credit card interest rates are reaching record highs. You'll also see a doubling of interest-free and balance transfer cards as people look for ways to move around their debts, and being really on top of looking for offers and ways to manage that debt. And buy now, pay later on there as BNPL is, we believe, underreported and perhaps quite significantly underreported. Many people say that buy now, pay later is not credit; it's just another way to pay. So might not have ticked this box in a question around have you used, is this a source of credit or debt that you have? And we know that in our qualitative interviews, buy now, pay later came out very consistently as a common way to pay for Christmas, Christmas 2022, and people putting off thinking about that for 30, 60, 90 days into the new year. And then towards the right-hand side, while the amounts are smaller, we are looking at doubles or more in terms of the increase on debt relief products, hire purchase, payday loans, and mail order accounts, which might suggest more of a move to kind of some subprime or alternative products, even if it is at smaller volumes. And a bit like we did with savings, we wanted to look at changes in personal loan holdings for all of our segments. And based on what we saw in the survey, there was an increase in personal loans across all of our segments, especially unsteady starters and squeezed and sliding. While for some segments, this will be a good solution to a need for credit and to help them fill a gap, we will talk about some of the risks of this in the problem debt section. Now, on this slide, there's a lot of information, arguably too much information, but I've left it in because we'll share these slides afterwards, which will give you some time to get into the detail. But what we're looking at here is key changes in the sources of debt by each segment, which we dug into a bit more to kind of see where some of the trends were. So I'll just call out a few of the ones in bold. So unsteady starters, our youngest segment, are seeing a 40% decrease in making the full monthly repayment in credit cards. 8% of them are doing this compared to 10% across our segments overall, suggesting they're struggling to clear balances and some of them might benefit from consolidating those credit card balances at lower rates. For credit crisis families, this is a segment that's really defined by how often they use small amounts of credit. And we saw a significant decline across many sources of subprime credit. This suggests that the options available to the segment are increasingly hard to access. And when we combine this information with the previous slide, where we were looking at the double increase in some of those products, that suggests it's being driven by other segments who might be moving into these products for the first time. On difficult debts, somewhat surprisingly, we saw an increase in mortgage products. This was a group previously more of them would have been renting, so more are moving to home ownership. Given this was over the course of the last year, that was probably at a time when interest rates were significantly higher than they have been in the past, again adding to that debt. For forgotten families, this is a very small sample size we're talking about, so do take this with a pinch of salt, but we're seeing a 100% increase in home collected credit from a non-regulated source. Around the same time that we've seen home collected credit providers, regulated ones, exiting the market. We have more to come on this. Over the summer, we're going to be releasing a more detailed report into illegal money lending in all of its types. So certainly one to watch as we dig more into where those increases might be coming from. And finally, for ungolden years, which are our pre and post-retired segments. Previously, I would have described this segment as one that was very anti-credit and kind of really reluctant to take out credit. And what we see here is kind of two big increases. A big increase in borrowing money from family and friends, which we know from the qualitative interviews we've done that that's a real kind of emotional pain points for these groups. We'd heard when we first did the research at the start of 2022 that borrowing money from family members would be kind of a real low point. So to see an increase here suggests people are really, really struggling. And an increase in catalogue debts, which isn't as big an increase, but does take this group to closer to the segment average. So even in our kind of older pre and post-retired segment, we're starting to see real changes in how they're using and accessing credit. So what does this mean in relation to demand for credit? We know it's continuing to rise, and people in financially vulnerable circumstances are increasingly hard to serve. Our two most vulnerable groups, credit crisis and forgotten families, have seen significant reductions in the sources of credit available to them with the market exits, which means that they're really going to struggle when it comes to kind of filling income gaps. However, there are success stories, and at Fair4All Finance, we continue to work with organisations who have effective ways of reaching and serving consumers to build financial resilience. Just last week, Responsible Finance released their impact report showing that personal lending CDFIs provided over 90,000 customers with 46 million in credit. This market might be difficult to serve, but it is an opportunity for organisations who are willing to design around their needs. And again, I'll mention our banking reports. We are encouraging banks and other organisations to widen their credit options to support customers in financially vulnerable circumstances. Many of these customers on low or flexible incomes need access to personal loans that are for less than £1,000 and that can be repaid within 1 year. This is a big market to serve, and we'd love to see more people in it. Now I've talked about the demand for credit, I'm going to pass it over to Tom to talk about problem debts.
Yeah, thanks, Lauren. And I think some of the themes that we've seen emerge over this past few slides we'll revisit again in these next few. Some really interesting and concerning trends I think emerging here. First of all, comparing our segments in the financially vulnerable population with the national average, one clear and immediate conclusion: our segments are more likely to have debt. So overall, in this comparison, we see around 60% of the population nationally have some form of debt, not including student debt, not including mortgage debt, compared to more than 70% of our segments. And the other thing that comes through again quite clearly is that debt is likely to be at a higher level as well. You can see that in those lower bands, there's a fair amount of consistency comparing the national average and our financially vulnerable population, but things start to decouple once we get into higher amounts of debt. So around that kind of £2,000 mark, in that bracket of 2 to 5k debt, around 8% of the population nationally are in there, but around 11% of the financially vulnerable population. Is a similar story for the next band between 5,000 and 10,000. 10% of our financially vulnerable population are in there compared to 7% nationally, and a similar story again with quite low numbers, but a significant gap between 10 and 20,000 pounds worth of debt. We see 7% of the financially vulnerable group in there, but only 4% of the national average. So more likely to have debt and more likely to have it at a higher level as well. And moving on to the next slide, perhaps unsurprisingly, if we see more debt and higher levels of debt, they're also more likely to report struggling with that debt. So again, comparing our financially vulnerable population with the national average, we can see quite a significant change, quite a significant gap, in the proportion of people who say they're struggling to repay the debt that they owe compared to the national average. Also, 30% of the financially vulnerable population say that their level of debt has increased over the past year. That's a bit ahead of the national average. And also, our financially vulnerable segment, perhaps quite concerningly here, are less likely to be talking to somebody about the level of debt, less likely to be able to have sought debt advice, slightly less likely to say they will seek debt advice in the next 12 months, and just slightly more likely to say they don't know where to turn for financial help. So higher levels of debt, and also higher levels of struggle with debt as well. Now, one of the things that this leads to, moving on to the next slide, is partial and missed payments on personal loans. So kind of picking up the other end of the story from what Lauren was saying earlier on. So more and more people here, and this is comparing the data we collected at the beginning of last year in March with the data we collected at the end of last year, and just some really stark trends in the data coming through, really worrying as well. Increases in the proportion of people who are either missing payments entirely or just making partial payments. Obviously, this is what we're seeing in our surveys. Really interested to know from people if this is what you're seeing in the market, what providers are seeing as well. But just in terms of the data, we can see that back in March 2022, about 2/3 of people with a personal loan have made a repayment in full. That's now less than half. We're seeing a big increase, up to 29% of people who made a partial repayment, pretty much doubling the proportion of people who said they made no repayment. And we are dealing with small figures here, but a really significant increase in the proportion of people who say they have several months of missed payments. So going from the 3% a little over a year ago to 8% just before Christmas. So worrying trends there. I think looking at this in a bit more detail and looking at it sort of segment by segment, we're seeing pretty much all the same story across every segment. We've removed the Ungolden Years segment from this slide. We're dealing with quite small sample sizes across the board here. So that is an important caveat. The Ungolden Years segment, much less likely to have loans generally. But across segments, we're seeing high levels of people struggling to make repayments and some really significant increases amongst those who were lowest last time round at the beginning of last year. So the squeeze and sliding and difficult debt segments. This time last spring, we're seeing quite a small proportion of people in those two segments saying they were struggling to make repayments. That's now up significantly, up to half of people in the squeeze and sliding segment. And those segments where we were seeing a reasonably high proportion last time, that's either maintained that level or increased even further. So something common to all segments, something that we're seeing really just across the board. And finally, from me in this section, really interesting, I think, in this context to look at people's priorities for 2023, how their goals for this year compare between the national population and the financially vulnerable population. There's a couple of things that we've really highlighted here. It's clear that the prevalence of problem debt really is looming large for our segments compared to the national average. 36% of people in our financially vulnerable population say one of their top priorities for this year is getting out of debt or reducing debt. That's compared to only around a quarter of the national population. And for some people in these segments, getting a new job might well be a real priority and a route out of that. That's something that we heard quite a lot in our discussions, qualitative discussions with the segments, particularly the unsteady starter and squeezed and sliding segments in particular. Thanks, Lauren, back to you.
Thanks, Tom. Yeah, and I think it's really important to look at the credit and the debt side side by side. So what do we know? We know that debt levels are increasing, people in financially vulnerable circumstances, with those increases, 5% above nationally representative levels over the last 12 months. And at the same time, that debt is becoming harder to repay for many who tell us they're struggling to repay, to make those repayments that they owe. And combining our data with kind of that initial look at the FCA data, we are seeing significant amounts of people will be struggling to make these repayments. We know that consolidation lending can be an option for some people in some circumstances, particularly where restructuring regular payments and reducing the overall cost on existing debt can combine to improve both short-term financial stability and longer-term resilience. We also know that this must include closing existing facilities rather than just adding to someone's debt level. And as Tom said, we know that customers in financially vulnerable circumstances are less likely to speak to people for advice and information. We see that across all parts of the journey, not just at the point when someone is in trouble, but obviously it's really important that when people are struggling, they start to reach out and speak to their providers. So really important to be thinking about this in the customer journey and how we can help people to reach out when they need help. And what else can be done? We are aware of at least one major institution that's proactively moving persistent debt to a lower interest rate, saving customers hundreds of pounds. And I think it's really great to see organisations that are taking those proactive steps to help customers who are really struggling with their debt levels. So what next? before I move on, say we are somehow miraculously running slightly ahead of time. So Tom and I will have time for some Q&A, both in terms of the data, and I'll also ask Tom to jump in on what he saw and his team saw in the kind of the qualitative analysis as well, because I think it really brings some flavour to the data. So do feel free to put your questions into the chat while I go through these last couple of slides. So what next? At Fair4All Finance, our strategic priorities remain the same. We are looking to expand the provision of affordable credit, to partner with banks and financial services providers to increase provision of services, and to develop new products and services to address market gaps. We'll continue to use our segments to design and deliver propositions that work to improve financial resilience. And later this year, we'll share our plans for how we'll work with customers and providers to co-design and deliver pilots to the market. If that's something you'd be interested in knowing more about, do feel free to get in touch with me, and I'll add you to our mailing list. And of course, there's a lot on here, but this is shows the number of ways that you can work with us at Fair4All Finance and kind of what we're currently working on at the moment. And although this isn't a very hard and fast rule, I'd split this into 3 categories. Primarily, if you're here as a community finance provider, you're most likely to be focusing on the left-hand column. We are going to be consulting on our Community Finance Resilience Fund in June, and we'd like views on how to best make £5 million accessible and helpful. So you can speak to my colleague Vince. We're looking at the next phase of our awareness raising activity. You may recall that we've been doing some work in the press around raising awareness of community finance, and we're kind of looking at what we do next with that. You can speak to my colleague Alex. And we are open to supporting strategic mergers between credit unions and not-for-profit lenders, subject to our criteria, which is with Kate. Banks, insurers, and other large financial providers, you're more likely, but not exclusively, to be in the middle column. We are offering deep dives into specific segments with organisations who are ready to design and deliver new propositions to meet needs at scale, or who make iterative developments to serve these customer groups, or who can deploy funding to support wider financial inclusion initiatives. And for that, you'll be speaking to my colleague Deanna. And finally, on the right is where we're looking at new propositions to address market gaps, which is for anyone from a financial services provider. So our 2 priorities are scaling the no interest loan scheme pilots on NILs, including mainstream lenders. You want to speak to Georgia, and our consolidation lending pilots for these segments, which will be with Kate. And what we're really looking for there is organisations who have both the power and resources to be in a position to drive change. We know we can't do this by ourselves. We know it's going to take some really sizable players in the market if we really want to improve financial resilience for our segment. So please do get in touch if that's of interest to you. And as I said earlier, we have funding available to integrate benefits and grants calculators into more journeys. And you want to speak to my colleague Senthan for that. So plenty to go at. I hope you found the information here today useful. I think, it can be quite a bleak picture at times when you're looking at this data and speaking to customers, as I know many of you here will be seeing and experiencing every day. So I'm glad that we'll be able to share some opportunities for people to work with us and some data to hopefully help you drive change within your own organisations as well. So thank you for spending some time with us, and we're now going to try and come to Q&A without hopefully losing the slides. Let me have a look at the publish. David from Hoot, are there other non-vulnerable segments or personas that could be added for context? I think not so much personas, but that's why we have shared the nationally representative data where we can. I'm sure other organisations would have their own personas that you can that would give a different view of different groups. But for us, it's about the 6 segments of people in financially vulnerable circumstances compared with the nationally representative groups. And have these findings been broken down on a regional basis? I think the short answer is not yet. The slightly longer answer is we have number of people in each segment by local authority to be able to say how many people in each segment are there. And that's from last year's data set. And we will be looking at doing regional analysis on this data, but we haven't yet, and we'll just be mindful of sample size. But we did go for a good spread across the UK. I can see Tom nodding.
Yeah, that's right. So the core data from which the data that we've seen today is generated from two large surveys from across the UK, each with around 3,000 respondents, which does permit us to break down into all sorts of different subgroups, region being one. Obviously, always looking out for what the limitations of sample size allow there, but yeah, regional analysis definitely possible.
Thanks, Tom. Paul comments, buy now, pay later. It ties in with what you're seeing at MAPS. People in financial difficulty are using this. Yes, I think it's the usage of it and that perception, which is interesting, and one to keep an eye on. Tom, I don't know if there's anything you want to speak to from the interviews about how people were using it and kind of how they felt about buy now, pay later.
Yeah, so I mean, I thought you covered it really well in the presentation there, but a real split, and we found this repeatedly when speaking to people face to face about buy now, pay later. Some people sort of saw it as a credit product straight away, and either they were fine with that, or depending on their perception of credit, it was just a no-go area for them. Other people, and particularly people in younger segments, were less likely to see it that way. They saw it as different to credit cards and actually didn't really see it as a credit product at all, saw it as just another way to pay for something. And often, when that was the case, they hadn't yet got to the point where any kind of late charges or interest payments had kind of kicked in. It had just been a question of spreading the cost, but obviously there's always the chance that you do get into that. When we were speaking to people more around Christmas, so in December and January, about sort of 5-6 months ago, it was a real tool that people were using to manage expenditure over Christmas. It's how people were budgeting for Christmas, and whether that was just a case of kind of pushing it into next year, so it's one less thing to talk about, it's to worry about something for January, February, that kind of thing, or whether it was more part of a sort of plan spreading the cost, really widely being used. I guess the other thing to say is people who used it a lot had developed their own little kind of rules for using it. They kind of set themselves their own little kind of credit limits. Oh, I never go above £500 or £600 or whatever in terms of what I owe. So whether or not people saw it as a credit product, people certainly using it as one, and using it increasingly in the run up to Christmas.
Great, thanks, Tom. I'm going to come back to you. Oh, sorry, have you got more to add?
Yeah, I was just going to say, just seen a question here from Paul Murphy, which I'm happy to take on. Just saying a lot of the percentage differences between the segments and comparing national to the financially vulnerable are often small, often only 1 or 2%. Are these statistically significant? It's a really good question. The rule of thumb for the data across here, it will vary slightly depending on the subsample size, but a difference of around 3% or more would be statistically significant. So where we're seeing differences of 1 or 2%, no, we wouldn't say they're statistically significant, but we might say that they're indicative, particularly where they're all really kind of pointing in the same direction, where it's telling us a story that we've seen either in other parts of the data or in other parts of the research. Obviously, through the commentary and through the presentation, we focus most heavily on those differences where they are statistically significant, so 3% or bigger, and some of the differences we've seen either over time or comparing the national population with the segments are much bigger than that indeed.
Great, thanks, Tom. That's the question I was going to ask you, so I'm glad you were ready to jump in. More of a comment from Fiona Turner, but I will pick up. It says, at an industry level, impairments across all mainstream bank credit products are fairly flat, ticking up a little but not statistically significant. Presents a different picture to the segments we're experiencing, which aligns closely with the debt advice client picture we're monitoring closely. Yeah, I agree. I think I've heard, when I've been to kind of different sessions by different conferences, I've heard that what I've heard, I think anecdotally, is the picture isn't as bad as people expected it to be yet. And I think they're expecting kind of impairments to kind of tick up over the course of this year. And I think that speaks to where our segments have credit products. So while I would expect that squeeze and sliding and difficult debts will be represented in kind of mainstream portfolios, some of the other segments that are really struggling to make those repayments might not be. So I think it's one to watch. Agree, monitoring closely, see what changes over the next 6 months to a year. Question from Sakib that I will only mention briefly. Has the NILS pilot had any impact on the customers where the pilot is being run? Short answer is yes. We are internally, we look at NILS reporting monthly, and I believe we'll be kind of publishing an interim view in the next few months, or an interim evaluation on what those impacts look like. But yeah, it's been really interesting, I think, to see the positive impact on people, for the reason that we set the no interest loan scheme out, recognizing that there are people who need a small amount of credit, often in an emergency. I mean, I say that knowing that we've had kind of two kinds: people with an emergency need, something has broken and needs fixing, for example, while also other people have had more kind of positive case studies, like needing to buy a new car so they can return to work after an illness. We've seen a real mix of reasons within there where there is real benefit to the individuals, and we'll be looking more broadly at the kind of the societal benefits as that sample size increases and we can do that first lot of evaluation. Has the financially vulnerable group grown from 17.5 million? I would say yes. The official answer is we won't do a resizing of that total number this year. So that's because it's based on data that comes from a number of sources, including CACI's Fresco data. It might include census data. So that resizing will be something we would probably do every 2 to 3 years rather than overall. One of the things we have been working with Trajectory on, rather than a different sizing of those groups, is what's changed within it and what are the sub-segments within those groups. So sometimes I will talk about it within squeezed and sliding, which is our biggest segment. I think it's 3.9 million. There will be people who are more vulnerable within that, and kind of at lower income end of squeezed and sliding, or higher debt level end of squeezed and sliding. So we're starting to think about those behaviours within group. And if people change groups, I think something we noticed this time, but we haven't dug into fully yet, is as more people in squeezed and sliding have higher debt levels, squeezed and sliding could, and difficult debts are almost becoming one mega segment, because it was the kind of the level of debt was one of the defining characteristics between the two groups. So interesting to see how many squeezed and sliding move into that kind of that higher debt segment as we dig in more into this data. Joel from Co-op: would we offer incentives for organisations to ask their members to complete the survey? We didn't do that this time. We worked with credit unions and CDFIs last time to reach memberships, but yeah, I think it's a good question for follow-on surveys, and happy to pick up with you when we're doing a future one. I'm reading these questions live as I'm getting to them. So CDFIs are having their business models severely tested as mispayments and debt write-offs climb. Yeah, we know CDFIs really serve some of the more vulnerable groups that are hard to serve. It's happening at a time when demand for credit is rising. Do you see the need for greater subsidy for lenders such as CDFIs? I think it's a really challenging market to serve customers in. I know the CDFIs we speak to regularly, which is most of them, it is increasingly challenging. And we work closely with Responsible Finance, the team there, and we speak to individual CDFIs to kind of understand those challenges better and kind of work through what's best for the market. But I agree, it's a really challenging time to be supporting these customer groups, which is why I think it was so uplifting to see the impact reports last week, speaking to kind of number of customers served, number of jobs created, and kind of the role of CDFIs within this group. Will we be sharing the slides after? Yes, we will, and that's a really good prompt for me to say, as well as these the slides we've talked about today, there is an appendix that has much more data per segment. So we've looked at savings behaviour for each segment. We've looked at debt level, debt sources for each segment. So I think there's 3 themes with 6 slides each. So we know that some organisations have really taken the segmentation materials and used them as their own to inform proposition and service design, which is really brilliant. So we're trying to provide more information to people who are in a place where they can kind of take that on and make kind of real change within their organisations, and happy to speak to anyone who's in a position to do that and kind of wants to chat about how we can make that happen. Just going to take a little sip because I feel like I'm just bashing out these questions. Be useful to broker relationships between mainstream financial service providers and affordable lenders to refer failed applications. Short answer, agree. Longer answer, I know there's some in the works, and we'll kind of keep trying to move those conversations forward. And some of the banks I know are looking into this. Can we get the raw data to use to some of our own analysis from Anonymous? Potentially. I think there's a question around privacy notice and what it would be used for, and how we can transfer it. So I think if there's a need for analysis, get in touch, and we can have a chat about it. But yeah, it probably depends if it's not already in the charts, and making sure it's not that it's kind of compliant with all the GDPR regulations. And I'm just looking at some of the other ones. How might a startup leverage your network to co-conduct user research? It's a great question. It's a question I've been asked a couple of times in the last few weeks around how we can access more people within our segments to for people who are looking to understand these groups, and so they can design better solutions for them. And for me, my answer would be around partnering with people who are already experts in this space, whether that's credit unions, CDFIs, housing association providers, debt advice providers, really anyone who can provide a real life view into these customer groups. And then, of course, like one of our principles will always be, and paying for people's time. You know, people really share their insights about their lives and their stories, and just making sure that you are kind of able to pay people for their time when they're taking part in a research process. Tom, I mean, you've done a lot of finding people who are hard to reach groups. Do you want to speak to that?
Yeah, I think the core principle is you have to go to them. It's been a big part of how we've designed the research over the past 18 months or so. You can do a certain amount of using conventional methods, and you'll find a lot of the kind of people that you want to speak to in those things. But ultimately, to really reach this market and people that are really struggling, the most excluded, the most vulnerable end, you have to go to them. So one of the big methodologies that we've deployed to help us do that is just really kind of pitching up in towns, in cities, in high streets across the country, to get people on the street, basically to give us a bit of their time and tell us about how they're doing, how they're faring, answer a few of our key questions. Yeah, it's just a really important principle. Thinking about things locally, and yeah, taking the research to the audience that you want to learn from.
Thanks, Tom. Well, that was a really great Q&A. Thanks for all the questions. I think it's worse when it's terrible when we have these sessions and there's no questions. So thank you for the engagement and some good things to think about. As we said, we'll share some slides after the session, if not this afternoon, then tomorrow. We'll put the recording of this session online in the next few days. There are materials already on our segmentation link, which you can download, which includes 2 reports from last year looking at in more detail at credit and loan usage by our segments, and one around marketing channel usage and communications to inform marketing strategies. And we'll have more to come over the coming months. Some of the pieces I've already mentioned are financial inclusion action plan, illegal money lending research, and more on the segments as well. So I guess all that's left to say is, Tom, thank you for co-presenting with me today. Thanks again for the questions all, and I hope you have lovely, warm, nice weather bank holiday weekends when it comes, and look forward to speaking with many of you soon. Thanks, everyone.